What happens if a crypto exchange lacks sufficient liquidity? In today's fast-paced crypto market, liquidity is a hot topic. Many traders are asking, what happens if a crypto exchange does not have enough liquidity? This question is more relevant than ever, especially with recent market fluctuations. Just yesterday, we saw significant movements that highlight the importance of liquidity in trading. So, let's break down what this means for traders and exchanges alike. When a crypto exchange lacks sufficient liquidity, it leads to several challenges. First, we see increased price volatility. This means that even small trades can cause large price swings. Traders may experience slippage, where the execution price differs significantly from the expected price. This occurs because the order book is thin, and large orders can quickly consume available liquidity. Next, we have order execution delays or failures. On centralized exchanges, low liquidity can result in orders not being filled immediately or only partially filled. Market orders may execute at unfavorable prices or ranges pending longer than expected. On decentralized exchanges, which relying on liquidity pools, a lack of liquidity can cause transactions to fail or revert. In addition to these issues, trading fees can increase. Some exchanges raise fees when liquidity is low to compensate for the heightened risk and volatility. For instance, decentralized exchanges typically charge a percentage fee on swaps. With low liquidity, the effective cost to traders rises due to slippage and price impact. Market manipulation risks also increase in low liquidity situations. Large traders can execute trades that drastically move prices. This can trigger stop-loss orders or panic selling among smaller traders, leading to sudden price crashes or spikes. Moreover, the type of orders traders use can be affected. Limit orders may ranges and filled for longer periods. Market orders can suffer from poor execution prices due to insufficient opposite-side liquidity. On decentralized exchanges, automated market maker models depend on liquidity pools. If these pools are depleted, swaps can become inefficient or impossible. The differences between centralized and decentralized exchanges are notable. Centralized exchanges maintain order books and relying on active market makers to supply liquidity. If liquidity dries up, they may face rapid price crashes and increased volatility. Sometimes, they may need to halt trading to protect users. On the other hand, decentralized exchanges use liquidity pools funded by users. If too many liquidity providers withdraw their funds, the pools shrink. This increases price impact and slippage, discouraging trading and further liquidity provision. A recent example illustrates this issue. Just earlier this week, a sudden withdrawal of $47.59 million United States dollars in liquidity from a sector on a platform triggered a sharp price collapse. This event showed how quickly insufficient liquidity can affect the market. In summary, lacking sufficient liquidity on a crypto exchange leads to unstable prices, higher costs, poor order execution, and greater risks of market manipulation. Both centralized and decentralized exchanges face these challenges, making liquidity a key factor for healthy trading conditions.